action, and welcome to Shift Happens. This is definitely a year of that. One thing I do want to share with everybody, times change. The number one elephant in the room that we all talk about is interest rates are jumping up. How many people have been in this business long enough that we've seen rates jump up? Right? They always do it. What will always be constant is rates will always move, but people will always be buying homes regardless of the interest rates. We just got to get them over the hump. The one thing that is also inevitable is people get older, right, George? Right, Chuck? That was only said because there's birthdays happening. So our babies get older, they buy houses. The older folks, they get older, they downsize. So the one thing that is absolutely constant is real estate will never go away, regardless of what interest rates are doing. I was in the business when interest rates were in the 20s and people were lined outside of my door refinancing for the teens. So the fact that we are moving out of an interest rate market with 30-year rates that were in the twos, I can tell you, I never thought we would see that day. So that was a gift that has to stop giving at some point. So that's where we're going to talk about people and their emotions and what this looks like. Because right now, everybody's in panic mode, aren't they? Your buyers, sellers, everybody's in panic mode because the rates are going up, they're going up, going up. But we're still under 5% at the moment. So money is still cheap, right? Okay, let's see if this works. It does. Okay, so what is happening in today's market? Contingent contracts are still a no-go. Wouldn't you agree, agents? They're still not, we still have no inventory. We still have very competitive offers, and it's just still a bloodbath for buyers. So we do have answers with this. It's not a one size fits all ever. There are recast options. We can do piggyback mortgages. So this is where you really separate the mortgage professionals from the mortgage application takers. This is a very volatile, emotional environment that we are in right now. So you do need to have professional lenders that know how to navigate these waters with you and beside you. So if I have ever expressed this, I'm going to say it really now more than ever. You need your lender partners beside you when you're having conversations with your prospective buyers, because they don't know all of the options, all the obstacles, and everything is still hurry, 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 right? So what we want to do is just let them breathe a little bit and tag team and take care of them together. Recasting loans, if you don't know what that is, basically if someone has a house to sell and they've got a ton of equity in it, but they won't be able to utilize that money, they can put 5% down instead of their goal of 20% down. As long as, and the lenders have to approve it. We have multiple lenders that Motto works with that do permit a recast. They can take the proceeds from the sale of their home after they close on the new home and put a lump sum down. And what will happen is the lender will reset the principal balance, but they will also reset their monthly payment to match what the new principal balance is. So that's what a recast is about. Usually when you do additional principal payments to your loan, your monthly payment does not change, right? Unless you're in an adjustable rate mortgage. If you are in a fixed rate loan and you're paying additional principal or anything, if you do not do a recast, your monthly is not going to change. So this is the kind of things that we want to help you educate your consumers so they're not as afraid of making this leap and making decisions without having their current home sold. Piggyback mortgages, that has been around for a long time. If they meet the qualifications, and First Home did a really great job talking about that in their presentation with doing home equity lines of credit behind the first mortgages. And that way they can structure their first mortgage. If they haven't sold their current home, they can set their first mortgage up so that it's at the end result of where they want their loan to be when they do sell their home, and they can pay off that equity line of credit. So there's so many ways to structure it, and we want to be there to help you do that. Okay. Do you have any questions, or John, do you want me to save questions for the end? Sharon has a question. You have to unmute.
Yeah, take them as you go along. This
Okay.
may provoke
Yeah.
some thoughts. One thing I thought of is for the new people here, could you just briefly explain the impact of if they decide to send one extra mortgage payment in a year? What does that look like on a 30-year approximately?
Yeah, thank you, John. So if they pay one extra mortgage payment a year, it could potentially cut their mortgage term in half. Typically, if you are on a 30-year mortgage, you're not going to start touching your principal balance in the first 4 to 5 years. So this is a wonderful opportunity to gain equity in your property sooner than later. I think that's fantastic. Great point. Sharon, you had a question?
On the equity line, so if you're saying, so I can take my current home and can I get an equity line for the equity that's in my house and then
Yes.
use it?
Yes, you can. Yes. So
And
that is permissible borrowed funds. I'm glad you asked that question. So you cannot borrow money to purchase a home
correct.
unless it is secured against real estate. So yes, people can absolutely take out a home equity line one of two ways. So our home equity lenders, which most of us use, I use them, First Home uses them, Tower Federal Credit Union, we all love, Reed Voorhees. If they know that that is going to be a departing home and they're not going to be retaining it, they can get creative with it, but and they can offer equity lines. They don't expedite it as quickly as they would if you were putting the equity line on the home that they're purchasing. Does that make sense? So when I say do a piggyback, the mortgage they take out on the new home is going to be 20% first 80% first mortgage. And then you can piggyback that with a home equity line of credit on the home they're purchasing for 5 to 10 to 15%, so that they're not having to come out of pocket with those funds. Does that make sense?
Is there a limit on the amount?
Yes. There's limits with different lenders. I believe, and don't quote me on this, I will definitely verify it. Tower Federal, I believe they've raised their limits to 300 or 350. At one time it was 250. Where's my Terry? He probably knows that. But anyway, yes, different lenders, and they can go to their own banks to do a piggyback. They don't have to use our recommendation. They're permitted to use anybody that they want. The other restrictions is on the first mortgage. So the combined loan to value cannot exceed the requirements of the loan terms with the first loan. Does that make sense?
Yeah, maybe at a different time, I'd like to discuss that with you more specifically.
Absolutely. Absolutely. Great. That's really good questions. So I'm glad you brought that up. Okay, so interest rates, they are moving. Now let's get behind the scenes and see what the lenders are thinking, doing, and how they react to this. The lenders can't just, go into culture shock with everything with the interest rate environment moving. They also they need to protect themselves. So lenders do make adjustments. And as you all have seen, because this is already in place, they increase conforming loan limits to offset the high balance and jumbo interest rates. So that gives us some interest rate relief when we're doing these loans. That's also based on economic and employment and people's earnings, but it is also a tool to assist people with interest rate movement and jumps like we go through this. Loan level price adjustments. What this is typically lenders will have loan level adjustments in their interest rates that they offer that are tied to credit scores. If you put less money down, there's many variables with different programs where they were tacking on. If you're putting less money down, we're going to hit you with 1/8% in the interest rate. That's exaggerated, but that's an example of what a loan level price adjustment is. The lenders, when the interest rates were cheap, they were tacking on all these prices. If you're putting 10% down, 20% down, if your credit score is this. So what they're doing is they're easing up on that a little bit. So because the rates are climbing, they're trying to, make some of these adjustments go away to give us some relief. The mortgage service rates need to sharpen numbers to steady the roll. So what this basically means is mortgage servicing. When we had cheaper interest rates, people were paying off their mortgages faster. We were getting prepayments. So now that that's slowing down, the mortgage servicers, they don't want that to happen. So that's when they start readjusting their interest rates. So out of the gate, you're going to see sharp moves with interest rates jumping up on you. A lot of times this is an overreaction with lenders anticipating what the Federal Reserves are going to do because they know it's coming. And then what you'll see is they'll start to calm back down a little bit. So we're going to be on a bit of a roller coaster. So again, attached to your lender, attached to their hips, ask how it's moving, set the expectations with your customers that, you know, rates are really moving. We're going through adjustments. We're going to get you qualified. Worst case scenario, when you are shopping for homes, that's not the time to say, what's my rate? Is it? Can anybody tell me when they should start shopping for the actual interest rates? Nobody, 20 some people on here, nobody knows when they should start shopping for interest rates. They should start
Under contract.
Thank you. Yes. When they are under contract is when you have this conversation with what you're actually able to do. The reason being is you need to match the contract terms. If they do a contract that's closing in 30 days, you can't do a 15-day lock. If they're closing in 45 or 60 days, you can't do a 30-day lock. So we need to protect the consumers and have these conversations, because what's happening is they are going to become loose cannons on you. My agents that have been around for a while, and you've seen interest rates moving, how does your consumers start acting? They become loose cannons, right? They panic. So they start shopping rates, and my credit union can do this, and this lender says they can do that. So our job, and yours primarily, because you're their go-to person, is keep them calm, keep them under control so that they don't end up hurting themselves because they get into a panic with interest rate movement. That's why I want to share this behind the scene information with you. Any questions on this piece? Nope. Okay, let's roll. Okay. So that's where we are with interest rate movement. There is rumor that FHA mortgage insurance premium rates may go down. So the upfront premium and the monthly premiums are currently upfront is 1.75. The monthly, if they put less than 5% down, is 0.85%. There is rumor that they may adjust and reduce those fees, both upfront and monthly. I will be so happy to see that for our first-time home buyers and FHA people. They need a break. Agents, guess what we really need to do right now with these interest rates moving, with the market the way it is, with all of the craziness, with inflation? What should we do? Don't make me get up and do a happy dance, because I will, and then I'll start singing to you. We need to stay positive. If you're positive and you're confident, guess what happens? They're going to be okay. It's going to take the fear out. So let's do that for our consumers, because all they see is, oh my God, the interest rates are moving. So for us to keep our jobs, right? Because we want to do that. We want to keep people buying. We want to keep people selling. We want to create inventory. The way we do that is to be positive and provide people with the knowledge and information that they need to feel okay with the market movement, and share your stories that you've seen the rates in the teens or wherever they've been in the past. Mortgage money is still cheap. Feel like the Energizer Bunny, I'm on at least 3 cups of coffee, so woo. John told all of us this. Guess what's happening?
What's happening?
Rents go up. How much are they going up, John?
About 7.5% prediction.
7.5% for renting. So when you are talking to people and they're scared to death of interest rates moving, they should be more scared of renting right now, because not only is it going to go up this year, it's going to go up next year, and again and again and again. When you buy a home and you're in a fixed rate mortgage, that is not going to happen to you. So these are the kind of conversations to reel them back in as far as, rents are going up too. Let's have that conversation.
Yeah, I would think that for marketing purposes, if you're gonna add a niche this year, and I advise that you look for numbers of niches. It doesn't have to be a big one, but try to identify a community where you know that the rentals are in the area of $1,500 and target them and tell this story, because they're going to expect bumps, and usually those bumps are annual, you know. They may be able to finally understand that it pays to buy a house, provided they have some money to put down.
Yes, yes. And you know what? I'm going to reach out to the agents for this. I believe rental inventory is also low, isn't
Very
it?
low.
Yes.
Yeah. So that's kind of scary too. So if you're going to be out there, yes, Sharon.
Sharon, you have to unmute. You got to turn your mute button off. There you go.
There you are. Oh,
Oh, you muted again. There you go.
Okay, so the reason the rentals are evaporating basically, to give you an example, my daughter Laura's had to move twice because her landlord decided they were going to sell
Right.
because it's such a good seller's market. I have a client who was a landlord for 20 years and she's like, hey, this is the time to sell. So the rental properties are turning into sale properties. So
Right.
that's what's happening there.
That's a great point. Is Laura having trouble finding, the like kind property that she's got to move to? Because that's going to be a challenge.
Well, she's in a different area, so it's
okay.
not as crazy as here.
Mhm.
But she had to move from Ocean City, and then she had to move from a place in Virginia because the landlords decided to sell the place where she was living.
Right.
oh my gosh. And you know what? That is also an amazing point. So that's happening quite a bit. I'm hearing from a lot of people that, where I'm renting, they're selling the home. So this is an opportunity also, if you can have the access to rental properties with individual homes, to be able somehow, and I know you have to be careful with property management, but this is where we need to reach out and let consumers know it could happen. They could decide to sell the home out from under you. Let's see if you could be the one that buys it. So that's a great outreach for consumers. And then I'm going to get into that a little bit further in the presentation with what
Tammy?
other shifts are happening.
Tammy,
Yes.
Yes.
another,
a quick
talking about
question?
rentals, it's even apartments are going up. I moved my daughter out of an apartment. She bought a house in Pennsylvania, but her rent was going up to almost $2,000 a month for an apartment in Ellicott City. And the house she bought is about $600 a month cheaper than the rent.
Before tax incentives, right?
Yes.
Crazy. Yeah. Yeah. So now I'm going to touch on that on a slide. Now is the time that they need to be educated more than anything. Consumers need us and they're asking for our help. So
Tammy?
I won't get ahead of myself. Yes.
May I ask a quick question? I know that I have millennials that live with me, and I know one of the, and I'm happy about it, but I know one of the challenges that their group, they do, and their group of friends have is that they have $50,000 in student debt, and they can't. That changes things for them. Are there programs that Motto has, or can you talk about other programs that might be available to those folks, and how, as agents, we might be able to get that person from a rental that's $1,800 in Fells Point into a house?
Yeah, so actually, I am going to defer to our other lender that is with our group. First Home does the MMP programs. Motto Mortgage does not offer the MMP programs, and I know that does have a student loan forgiveness opportunity. So I would definitely reach out to First Home with that. They're very well versed in it. They've been doing them forever. So as far as the student loans, that would be the way to go. We are also, and I'll share with that in a slide as well, that all of the regulators are also reducing the minimum payment requirement with student loans. So that also opens up opportunities from a qualifying standpoint. The student loan debt is heavy and it's expensive for our poor kids. My children are going through the same, so it's quite painful. But I would absolutely reach out to First Home with the MMP program because they do have an outlet for that.
Great. Thank you so much.
Thank you.
Ellen, our reps on that are Ryan Paquin and Jay Franklin.
Okay. Because I know that that's a big challenge for a lot of folks that are
It
there.
really is.
Great question.
Yeah, in fact, the student loans balances, our daughter has a mortgage in the student loan. It's absolutely crazy.
Yep.
So thank you. That was awesome. Inflation. So what we need right now is asset retention. It's getting really scary. The cost of food, goods, everything is so expensive right now. But asset retention is going to fall into other key points. What is happening in today's market with employment instability. So I'm definitely going to be talking about that as well. So we are also here to help provide options that fit in today's economy and the near future with asset retention and how we can move money around for our consumers. And also at the same time, help them look very strong and competitive in their contract submissions. So I'm going to use this again, probably over and over. This is definitely not a one size fits all. And just because on paper, on these pre-approval letters, if you have a listing and it shows a down payment of 3.5% FHA or 3% for conventional, don't assume, my listing agents, please do not assume that that isn't because people don't have the assets. It's because they need to retain their assets. From a lender standpoint, when we're doing a loan and structuring it this way, it's stronger than people that are liquidating all of their assets and potentially at risk of a foreclosure because they don't have a nest egg. So this is very important that you do have these conversations and do a deeper dive. When you receive pre-approval letters from lenders, ask them the question specifically. When you see a low down payment, please don't push that pre-approval letter aside. Listen to their story and give them a fair shot at being a homeowner in these homes. Okay, shop home. Okay, I got ahead of myself. I love when I do that. So there's so many ways to reduce your monthly payment above just the interest rate. Homeowners insurance, that is part of your monthly payment, right? So with homeowners insurance, if you have good credit, you get better rates. So if we see like a normal application taker, mortgage application taker will see you have 700 credit scores or you have 650 credit scores, you're fine because you fit, let's move on. They did them a disservice because at 650, their homeowners insurance premiums may be much more expensive than it would be with a 700 credit score. So insurance companies do look at credit risks. They didn't back in the day when we were using typewriters and handwriting loan applications. They didn't care about that, but they do now. So shopping homeowners insurance based on credit and also based on different insurance agencies, it will absolutely help with their monthly expenses to help offset these interest rates. And that's what we want to do at Motto Mortgages Mortgage Professionals. We are not only outside of the box, we don't even have a box. So we want to provide all of the data and information so they can be well informed and make the best decisions and be comfortable with these quick decisions that they have to make. So this is something that you do want to speak to them about. Not only that, most insurance companies will offer a, what is it called, a blanket or umbrella policy. I typically still advise my borrowers to still shop their homeowners insurance because just because they say it's under one policy, that doesn't necessarily mean the homeowners portion of that is going to be the least expensive. So we still want them to shop that. Also, they can shop mortgage insurance, and it's not shopping it. I'm going to have Terry Healy with us talk on how they can also get savings with mortgage insurance. But I'm going to go back to what I was saying with credit rating. Just because we pull it and see, okay, this is in the range, this is good. If we can get your credit scores up another 3 points or 5 points, that could be a difference of as much as an eighth in interest rate improvement and reduction in closing costs. And it could be just paying down one credit card $500. That's an example, but it could be as simple as immediate improvement on credit. So even though the credit scores look good, we're going to help them go outside of that and look even better to save even more money. So this is not we don't stop at, okay, black and white, this fits. Do you guys have any questions on this stuff? No? Good. Not good. I want questions. Can you tell I get nervous on these sometimes?
Hey, Tammy,
You
Yes.
don't look very nervous. Yes, Terry.
one thing I wanted to point out on homeowners insurance, another way to get that premium down is to up your deductible, because it's less risky for the insurer, because then they're not dealing with a bunch of nuisance claims when a gutter starts to fall off a house. They're not sending somebody out there to rehang it for $300. You're going to pay that out of pocket. So just some food for thought on that.
That's great. I love that. All right, Terry Healy, you're on deck.
Okay. So anyway, we've all heard about mortgage insurance, and what that does, it covers the lender in case the buyer defaults on the mortgage. So if you're putting down less than 20%, you're typically going to have PMI or FHA, VA mortgage insurance. So anyway, there's certain ways around it. If you look at a conventional 97 versus an FHA 96.5% loan to value, your higher credit scores are going to do much better on a conventional deal, because conventional premiums are cheaper. And again, like Tammy said, with homeowners insurance, the higher the credit scores, the more affordable mortgage insurance can be on a conventional deal. On FHA, if you have a low credit score or you have an 850 credit score, the mortgage insurance is going to be the same for both of those buyers. There's not any break on the mortgage insurance based on credit score. Tammy mentioned earlier, FHA is talking about revamping the way that they're going to do the mortgage insurance. I heard that they're going to reduce the upfront and possibly the monthly, but we'll have to wait and see with that one. USDA is much like FHA, where it has the upfront premium and the monthly premium. VA has what they call a funding fee, and that funding fee is a percentage depending on whether you've used your entitlement previously or not. It's a lot more expensive if you previously used your entitlement, even though you've reinstated the entitlement. The other thing with VA, if they are medically discharged and on disability through the military, that funding fee is exempt. They don't have to pay that. So that's huge for somebody that is a huge benefit to somebody that is disabled from the military. I've had quite a few customers have been able to take advantage of that, and they're saving sometimes $10,000 to $15,000 that's not going to be financed into their mortgage. So keep that in mind. Also, we do have one lender that has a program called MI Buster, and what they're doing is basically charging a little bit higher rate on the mortgage, and then that way we don't have any monthly mortgage insurance. We've also heard of that is lender paid, but lender paid is going to be more expensive from an interest rate standpoint versus the MI Buster. Lender paid is what they do is they charge you a much higher interest rate, and the lender pays out of that higher payment that you're paying. The lender pays for that mortgage insurance premium. With borrower paid, it's a monthly fee, and it goes away on conventional deals. It can go away when you reach a 20% equity stake in the house. You have to petition to the lender to have it removed. If values increase significantly, it's a chance you could have that removed rather than waiting the 7 years that it used to take to remove mortgage insurance. used to be based off of the value or the equity that you've actually paid into the house based off the original value. Now they'll look at new appraisals and reduce or get rid of that PMI. So that's basically it with the PMI. The other way to get around PMI is to do what we call a combo. Tammy touched on this a little bit, where we do an 80-10-10. We do an 80% loan to value first mortgage, do a 10% home equity line of credit on the property they're purchasing. That way we don't have to charge the mortgage insurance because Fannie Freddie, who's doing the first mortgage, doesn't have any more than 80% exposure. So a good way to get around that. Another thing is that you have somebody that has a house to sell. Again, Tammy touched on this. We finance an 80-15, for example. They only have to put 5% down. A month and a half later, they sell their house. They can pay off that second mortgage. So it has a lot of nice moving parts. The other thing is when they pay that off, they can leave it open as an equity line of credit. So 6 months from now, the furnace goes up. Oh my God, where am I going to get $10,000? Oh, I got this home equity line of credit sitting here that's paid down to zero, but it's still open. So some advantages there with that. Again, with the combo, we can go up to 95% total loan to value. So that's about it on mortgage insurance. Tammy, if you have anything you want to add.
Yeah, I do want to add to it. So just like everything else, you can also get discounts on mortgage insurance, and the structuring is also key. So if you have an applicant that's they want to put 20% down because they don't want mortgage insurance, but they're in a bidding war. How much of that is going on right now, right? A lot. So what we do is we have the conversation with them. Rather than putting 20% down, let's put 15% down. The mortgage insurance premiums, when you put 15% down, is much, much cheaper than if you're only putting 5% down. So the cost for private mortgage insurance with your down payment is going to adjust significantly. There may be situations where if they put 19% down instead of 20% down, we may find that we get discounts on interest rates because it's an insured loan. So out of the gate, we're getting them a discounted interest rate. They're going to have mortgage insurance, but it's only 1%. So it quickly goes away with the mortgage insurance, and then they're left with a better competitive interest rate. The benefit of working with Motto Mortgage is one of our national wholesalers that we work with, they are self-insured. Actually, we have two that are self-insured. So they don't use outside PMI companies to get their rates. So they are very sharp with their numbers, very competitive with their PMI rates. So when the consumers are shopping interest rates, we are also very sharp on mortgage insurance premiums. And again, that's another part of the monthly payment opportunities to offset the interest rate movement. Shift happens.
In addition, on jumbo products, we only have to put 10.01% down. It has to be just a shade under 90% loan to value. It will not have mortgage insurance. So that's kind of nice in a jumbo market, because could you imagine what mortgage insurance would be on a 90% jumbo?
Right.
Probably $800 a month. So that helps get your payments down as well.
Absolutely. Thank you, Terry. That was awesome. Does anybody have any questions on this topic? Nope.
Tammy, just one question. Typically, what are interest rates looking like on the equity lines?
They're also credit driven. So they
Right.
could be prime +1, they could be 1 under prime. They're tied to prime. We've seen prime +2 with high LTVs, low credit scores. So they're pretty much all over the place, John. It's
And
really
I'll add to that. I did talk to Reed over at Tower not too long ago, and they have equity lines of credit, but they also have loans. So those rates obviously are going to, when they're loans, they're going to be a little bit higher. So of course, it all depends on what the borrower wants to do, but they are really flexible with rates. Especially right now. So they're really helpful, and they are able to, which was really interesting. So if you wanted to do purchase and do the first mortgage, and with that home, do the second mortgage. After you settle, you can actually go back to Tower and get a third mortgage and get up to 100% of the value of that home after you settle on that property, the day after. So that opens up a lot of opportunity for borrowers that may want to do some work on the house or something like that after they get into the property. So there's a lot of products out there for these borrowers, just to keep in mind. So,
You know, one of the things that's occurring to me as we go through this is for a real estate agent, for what we do, you know, matching buyers and sellers to properties, et cetera, et cetera. The financial discussion is a fire hose, right? And everybody out there is well advised, I believe, to make sure that you present the recommendation of who these folks talk to look at their financial picture as a case study. Everybody is an individual case study. It's like a doctor looking at somebody individually, really asking the right questions, hitting the right notes, taking the right temperature, and making the right advice, right? We're not as competent to do that as the trusted lenders that we have affiliated with RMA, but also there are many other lenders out there that do the job. Your point as a realtor is to get them in front of the most knowledgeable people possible so that those people can do the financial case study. You do your job and the rest of your mortgage team does its job. That's how it works best, guys.
I love it. The case
Yeah.
study, I like it.
Liz, I'm so glad you brought that up with the ability to go back and add the third lien, because that goes back to the inventory shortage, and people are settling for things and they feel tapped out. They may not like that orange shag carpet in that house and they don't want to have to live with it. Well, going back after the fact and doing that third piggyback loan is an opportunity so that they can do the improvements on these houses that they like, but they don't really love right now. So that's good information for the agents to have when they're speaking with the buyers while they're out there shopping. Thank you, Liz.
Welcome.
Okay, guess what is back, and it's so different now. Our first-time home buyers, it's not what they were even from a year ago. So if anybody's been around at least for a couple of years, even if you weren't in the industry, the hot topic was first-time home buyer seminars, home buyer seminars. It was saturated and it was becoming gimmicky, and it was not for the consumer. It was not in their best interest. It was to make sales and just, you know, capture business. Well, this day and age now, even from last year, we have really, it used to be about low credit score people repairing their credit, not having any money. So they had to use the grant programs, right? So when we saw these homebuyer classes, they were always talking about, if you have no money, you can do grants. And if you have bad credit, we can fix it. That was the majority of who attended our homebuyer classes. I created an entire forum. It was called Fresh Start Seminars. I've been doing them for 8 years now. It's not branding, it's pure information, and it really, really matters. This generation of first-time home buyers, they are starving for information. If I even mention holding a class, they're saying, where can I sign up? 3 of my RMA agents clients in a matter of 1 week said, where can I get more information? I'm Googling and I'm just not getting enough. So it is very different right now. I had already mentioned earlier, the student loan calculation requirements are very different in this time frame with being reduced with FHA and Fannie Mae, which is much needed for these poor kids. So what we have now, I already kind of went ahead of myself, but in the past it was about credit repair, no money down, grants. Credit repair, no money down, and grants. Listing agents, with the amount of inventory do we have, are you even entertaining these pre-approvals for the most part? Anybody can say yes, no, boo. So no, I know for fact, my very senior agents that have been in the business, they come right out and say, we can't look at those. They're too high risk. We have too many really good offers that are not risky like this. So we've got really good buyers out there. We just want to get them educated because they need our help. Now they're smarter. Their parents are teaching them credit is important, save your money. I am so proud of the generation of millennials that we have that are buying homes right now. They want information. That don't assume that they just go to the internet and that's where they're getting everything. They still want us as mentors, both realtors and lenders. And Ricky Cantori can testify to this. We do our buyer consults together, and it's just incredible how much they're like sponges. They absolutely love it. So they are very different. They want this knowledge. They've saved money. They have good credit. And there's that. So they need you and they need us. Let's get out there and be present for them. Liz, you're up.
Hi from the Eastern Shore. So we've had a couple of things that are impacting, Fannie and Freddie have come across with a couple of things that are impacting our market, certainly on the shore. And the first one is second homes. So Fannie and Freddie are implementing loan level price adjustments for purchasers buying a second home. And they are for purchases after April 1. A lot of our wholesalers are flexible with our submission dates, which is really good, meaning that we have some flexibility on when our drop dead dates to get our borrowers loans locked and loaded and into the wholesaler. They are doing this in direct relation to make affordability housing a little bit more affordable for first-time home buyers and low to moderate income home buyers. But these adjustments are going to be anywhere from 1 1/8 to 4 1/8, which is very significant for these buyers. And although these price hikes are a huge shift and parallel to what an investor might see as in their interest rates, a lot of these purchasers who are buying vacation homes, they do intend to rent them out in some manner. So they're still going to see the benefit of purchasing a second home. And in my experience, a lot of these purchasers have always thought that their rates are a little bit higher than a primary purchase. They weren't necessarily in the past, and certainly not significantly, but it's always how we talk to our clients about this. So I don't think it's going to impact them as much. Obviously, we know how much it is, but I don't think they're going to see how much that may impact them, because they were already assuming that there might be an increase in their interest rate anyway for their purchase. And then condos. So Fannie and Freddie have also come in and made some changes, and these guidelines were changes effective January 1st, and in direct relation to the Surfside condo collapse. So the most significant changes, we are going to rely on the appraiser to go and note any significant deferred maintenance on the building. And we're talking about significant, right? So not any, chipping and peeling paint necessarily, but structural issues or anything like that. So, and they're going to have to note that, and certainly if it's a concern, that building may not be eligible for financing. We're certainly going to look at any upcoming special assessments, take note on what those special assessments are, make sure that there's enough reserves to pay for those special assessments if they haven't already been paid in full. And a reserve set, so 10% reserve is required on all condos through the association. In the past, there was a reserve study that was eligible for some of those. So they would just take a deeper dive into the reserves, and there would maybe allow less than 10% reserve requirement, but they're not going to do that any longer. So it's going to be a 10% reserve requirement on these buildings. And then we're going to take a look at the last 6 months of the meeting minutes. So they're going to want to make sure that they're noting any special assessments that are upcoming, any maintenance that might be upcoming, or any upcoming construction on the building. So they're definitely taking a look at all of these things to make sure that that building is safe and habitable for the consumer. So now more than ever, of course, certainly we want to get those appraisals ordered right away, but this is really, it's critical that we order the appraisals right away and get the condo questionnaire completed right away so we can address any sort of issues that might come up quickly and efficiently. So these are significant changes in our market, but like anything else, we're going to embrace these shifts. If you have any questions, obviously reach out to any of us at Motto, because we are certainly here to kind of help you and your clients navigate this.
Thank you. Any questions on that one? That's a hot topic.
It's a hot topic. It's pretty serious around here, but again, like anything else, it ebbs and flows, and we'll get it through it, right?
Yes.
Liz, what's the condo market looking like on the Eastern Shore?
It's
Is it as
good. I mean,
challenging?
like anything else, we're still low inventory. We've seen a
Okay.
little uptick in people looking, obviously, because if their agents are saying, hey, you might see these impacted. I mean, I think these low level price adjustments are impacting the people that are currently looking more than the people in our future, right? So there's a little bit of, yes, let's go find something now. But again, the inventory, it's just, we need more listings.
Yeah, and actually, I'll piggyback a little bit more on the condominiums. Agents, if you have an opportunity and you have people approach you that want to buy these condo buildings or construct condo buildings, anything of that nature, Motto Mortgage, we are actually experts in that area with obtaining Fannie Mae approval. Terry's probably ready to laugh at me that I even have any hair left on my head. We just completed a condominium new construction building, 36 units, did a great job. So we are absolutely happy to have conversations to help you in that market as well so that you can get these clients. So what else is happening? Most homeowners have exited the mortgage forbearance program. I can get those words out of my mouth. But those who are left, they're still really vulnerable. So as I said, I'm going to retract a little bit with our home buyers. They are going to need assistance and guidance of how do I start over? Like, how do I get out of this? Am I ever going to be able to buy a home again? So we are here to absolutely help guide them and help them realize that, yes, you can absolutely buy homes again. What you're going to start seeing now is people are going to be opening up, and this may create some inventory for you as well. A lot of people that were in these PPP programs and the forbearance, they're coming out of them. So now they are in a position where they can look at their finances and see if they have an opportunity to buy, sell, refinance, do whatever they need to do. So that's going to become another opportunity of consumers that are going to need your help. So, you know, where we have challenges with low inventory, we've got inflation, there's always something that's coming up behind it that keeps us as lenders and real estate agents busy and needing to be the support system and educators in the market. One really hot button that we're seeing happen a lot, and this is from the Washington Post, nearly a third of the US workers under 40 are considering career changes. This is live and happening at all ages. I'm actually getting calls from consumers saying, I'm ready to get out of my business because through the pandemic, working from home, you know, the restrictions and different things, people are really rethinking about how they want to live their lives, and that includes employment. The challenge when people do career changes, when they do job shifts that take them from where they believe is in the same industry, but they're going from a W-2 income earner to a 1099, that poses problems because we have to have consistency. We have to do averages. So if you are having buyer consultation appointments, please ask them the question. I think it's doing them a good service, asking them, are you planning on changing your career in the near future? Are you doing anything there? Because then that will lead into how you can protect them from going under contract. And oh, by the way, I decided to change my career last month and didn't tell you, but I assumed I'm okay because I'm doing the same type of work. but I just went 1099 because I want to be a freelance person. This is probably, in addition to the interest rates, the condo rule changes, I think this is going to be the biggest shift that is happening in 2022. People are doing career changes, more contractor type jobs. So please be aware of that, because that directly impacts their ability to qualify and be able to get mortgages. Does anybody have any questions on that one? That one scares me. I'm trying to get the word out as much as possible. Please don't change your jobs. And we always recite that to people anyway when they're buying a home. When they sit down and you do your buyer consultation, you talk about don't spend money, don't let anybody pull your credit, don't go out and buy a brand new car, you know, don't do this, don't do that. More than anything right now, don't change your job. Have the conversation with your lender. Let us know what you're doing. Even if it's in the same line of work, please talk to the lenders. Any questions on that one?
I mean, to your point, it's really good to get the lender involved early, especially since a lot of companies were paying people salary and then realized during the pandemic it wasn't as easy to lay people off. So they've switched a lot of their workforce to hourly, which now becomes variable income. And we don't have a history at this point. So get the lender involved early so you're not spinning wheels.
Oh my God, Terry, that is such a great point. Can you elaborate on that a little bit, what that looks like? Because it's not always in the consumer's control that their employment changes and they're with the same job. So talk about that a little bit more, the difference between salary and then being shifted to hourly. And is it 40 hours a week? You know what I mean? So if you could just elaborate.
Yeah, basically salary would, a person that's on salary could literally get a job within a month or two, apply for a mortgage and get a mortgage, because we're considering that consistent income and steady income. We know what they're going to make. We have to assume that it's going to continue, providing they continue with their employment. However, during the pandemic, like I said, a lot of companies learned that it was a lot harder to lay people off that were on salary, but they could cut people's hours. So in other words, if Tammy was my employee and I had to cut hours, it didn't help me to cut her hours because she was making an $85,000 a year salary. But if she was on hourly, I could cut her back from 40 hours to 30 hours. And then that way I could keep Liz employed at the same time. So you have to look at that. And what they consider hourly is variable, because we don't know. We have no history of you being paid on a variable basis. So we have nothing to look back on to say, okay, well, they work an average of 40 hours a week for the last 2 years. And that's what we're going to look for on variable income is a 2-year history. So keep that in mind and make sure you get the lender involved early, because I get it all the time. I sit down and interview people and they say, yeah, I make 60 grand a year. And then I get pay stubs and it's, you know, one pay stub's 32 hours, the next pay stub's 42 hours, so on and so forth. And that's variable. So we have no way to predict unless we have a history of it. So just keep that in mind.
I think it's interesting, even if I know that they're hourly, because a lot of my borrowers will know that they're hourly. I'm like, well, is it guaranteed 40? Absolutely. Of course it's 40. You get the paycheck, it's 38. Then it's, you know, they went to a doctor's appointment and that impacts their qualification. So it's really important that hourly structure is very different than a salary. And they don't know it. They're not trying to be deceitful. They just don't realize it. So that's why we get the pay stubs, obviously, up front.
Great point. Thanks.
There are a couple of interesting, Terry, I didn't mean to cut you off. Did you finish?
I'm done.
There's a couple of migratory factors that NAR has predicted, and it's incredible. If you think our market's tough, try Florida. You know, with the amount of people retirement age looking in Florida, the trend, amazingly, is the hottest cities for new homes, new home constructions, and destination sites for people are in South Carolina, the states, I should say, not the cities, South Carolina, North Carolina, Iowa, and Idaho. Californians, Arizonians, and folks in Vegas are going to Iowa and Idaho. And East Coast people are going to South Carolina and North Carolina, right? And that's going to have an impact on our market. Now, to a large degree, there'll be, folks older, probably boomers, looking to relocate, which will help our inventory somewhat here. But that's the trend right now. More affordable, and the fact they're taking jobs there where they're only working as, COVID is leading us to do, 3 and 4 days a week from their home, and 2 and 3 days a week mobile. I mean, that's beginning to happen. NAR predicts that home sales in 2022 will be down about 3% from last year. And appreciation by the end of the year will average about 5%. That's good news. The double-digit appreciation is over, And this is going to take a little while, but by the end of 2022, I'll be very interested to see what this re-immigration or the remigration looks like in the country. We're going to have a very, very different map. Sharon?
On this South Carolina, North Carolina thing, it's not just retirees. I have a young couple, and we started looking here. I mean, they have good money, good credit score, a lot to put down, but they were looking at houses up to 600,000, and they were only finding older homes that needed a lot of work in their price range. And they went to visit some friends in South Carolina, and their friends said, "Hey, you can get a lot more for your money down here." And they are both working from home, so they talked to their employers and said,
Right.
does it matter if we're in South Carolina? And they said, no, doesn't matter, go ahead. So a lot of people, because they're working remotely, that opens up where they can go. So they're having a brand new home built in South Carolina, brand new,
Right.
all the bells and whistles, no basement though, because they don't really do them
Yeah.
much there, for 500,000.
No. And in those states,
So the younger people are going to South Carolina too.
yeah. And in those states, the turnaround time for the building of new homes, and particularly they're going to new homes, is much quicker than it is on the East Coast.
Well, what
Right.
they're doing, so they're buying from Lennar, and basically
Right.
Lennar said, this is what you're getting. This is the supply we have. You don't get to pick. This is what your home is going to be.
That's right.
And they just went under contract, I don't know, maybe a month ago.
Yeah.
They've already had their pre-construction meeting, and they should be in the house by June, July, which is what they need for their 2 kids to start school. And in this particular area, the schools are even good.
Yeah. I think part of the NAR study indicated that Lennar is the #1 builder in the country now.
Oh, I didn't know that.
Yeah, I think it is. Interesting stuff.
Yep.
Shift happens.
Does. Cassie Young, you're on deck.
Look at that mugshot. All right. So 2022, with inventory being so low and everybody being stressed and panicked with this market, with how it's starting off, I just wanted to hit the ground running. We as a team wanted to hit the ground running to build a lead generation, for our agents. And, John, you had a great business planning class, really enjoyed that. And I loved how we talked about community and involving the community. So insert light bulb, we came up with Thankful Thursday. So Thankful Thursday is a way that we can just get our footprint and expand it through the community. Everybody's talking to you. Everybody talks about you. It's just a fun way to interact and build that trusting relationship. The first Thankful Thursday, I had Trish Abrams from Westminster office come with me. We actually surprised the Carroll County Sheriff's Department. And the first thing they said is, "Oh my gosh, can we take your picture? We want to put this on Facebook." And we got a lot of love for it. And it's just that feel good, you get to do something for the community, the people that, don't get enough recognition day in, day out. You get to show them that you appreciate them. So absolutely love this idea. It's so much fun. I literally have all February booked up with agents already, going to different organizations and local businesses just to show that we see what they're doing. We appreciate them. So I think it's a great marketing opportunity for agents and lenders to partner up. So, whoever you have your relationship with, this would be a great idea to really partner up with them and say, where can we go to say, hey, we see you, we appreciate you.
Yes.
Cassie?
Thank you. Thank
Great
you.
point,
So,
great point, Cass.
yeah.
Cassie,
So, go ahead.
I've spoken to several agents out here that are very excited about that program, by the way, here and in Eldersburg. The word's getting around.
Great. And that's what I'm excited about is it's just, all the agents are, oh my gosh, can I join you this week? Can I join you this week? So I've already built up to where, we're booked halfway through March already for Thankful Thursday. And even the businesses, we go through local businesses for the bakeries, for other gifts as well to support them. So it's just kind of like get to talking like, who she got and where's she going next, and people get excited about it and it makes it fun. We forget to have fun sometimes in our job, and this is a great way just to put it all together. So after our meeting today, I'm actually leaving with another agent. We're going to do a Thankful Thursday, so you'll get a post after today's meeting as well.
Yes, and I wanted to share with all of our agents, this is a Motto Mortgage United program that we're doing for all of you in all locations. So reach out to your Motto loan officer in your area that you have relationships with, or if you would like to do this, all of us in all RE/MAX locations, we are doing this and we're very excited about it. So it'll be fun. So we look forward to hearing from you, and you'll be hearing from us as well. So that's it. Any questions that we didn't touch on? And I hope you got good information from this.
Tammy, this is terrific stuff. This is terrific stuff. I want to mention a couple of things to folks before we wrap up. We're going to do our business Zoom February meeting on the 16th. So put that on your calendars. We hope we get a big crowd on Zoom for that. That's our annual February 1st meeting of the year. And again, we have to do it by Zoom. Another thing that we have coming up, Tammy and I are working on a program where the program that she has successfully used for first-time buyers in the seminars, we're working on a way to present that to you guys. Right? So we'll look for an invitation to join that seminar. We have full intention of doing these live, right? They work better. Our hope is to do one in the Howard County offices, then followed by one in the Carroll County offices, and then over on the shore, right? And these will be invitations, and we're hoping to hold them indoors. Fingers crossed. We know that times are still, from week to week, can be crazy. But we really believe that putting people in the same room, we want to do that as quickly as we can. We're very conscious of that. Connectivity in this pandemic area has been, it's been a strain, and as soon as we can open up the doors and the windows and be together, that's good. So one of the first programs that we want to try and do is to have Tammy teach you what she's teaching the buyers in these seminars. And you'll get a workbook, and it should make you first-time buyer experts overnight, right, Tam?
Yes, absolutely. Sharon Marshall has seen it. A couple of our agents have seen the PowerPoint. It is going to be current, not dated. When I saw the date of it initially,
Yeah, we were looking at all that stuff. It was great.
So yeah, thank you. We look forward to it.
So be looking for that. We'll probably be inviting folks by a lone wolf, on the all call message to the whole company. And we're looking to have a minimum of 10 to 15 folks per location in the session in order to make it very, very lively and to make it worth our time. Oh, there's lovely faces down at the bottom before we close. That's great.
Thanks, Tammy. Thanks, everybody.
All right.
Thank you.
Great job,
Everybody
folks.
safe.
Hang in there. Be hopeful. Spread hope. Keep hope alive.
Yeah.
Thank you.